You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. President Trump and other senior Republican officials have ramped up their criticism of the Federal Reserve recently, especially Fed Chair Jerome Powell. The FOMC's decision to hold off on cutting interest rates because of the upside inflation risks from tariffs has led the president to reportedly go as far as drafting a letter firing Powell. Recent construction cost overruns for the renovations of the Fed's headquarters have also been used as ammunition to potentially remove the Fed chair. On today's special edition of Simply Put, we talk with Carola Binder, Associate Professor of Economics at the University of Texas at Austin, about the value of central bank independence, how legal protections can be less important than institutional norms, and how the Fed might fare during this episode of Political Pressure. Stay tuned. Our guest today is Carola Binder, Associate Professor of Economics at the University of Texas at Austin. Carola, thanks for coming on the podcast.
Sure, thanks for having me.
Our topic today is central bank independence, its historical relationship with economic outcomes, and how the Fed might fare through the current episode of criticism. Now, central bank independence is talked about like it's this crown jewel of modern macroeconomy. So, Carola, what is it, and why is it considered so valuable?
Yeah, so central bank independence is the institutional setup that keeps the central bank, especially its monetary policy, insulated from politics. So it might include things like relatively long-term limits for members of the Monetary Policy Committee, difficulty firing members of the Monetary Policy Committee, and other sorts of protections that make it so that it's hard for the president or other elected officials to determine the course of monetary policy. In the U.S., we didn't always have central bank independence. The starting date that's often given to it, although it really was like a long and evolving process, was 1951 with the Fed Treasury Accord. During World War I and World War II and part of the Korean War, the Treasury really had a lot of control over what the Fed did. And in particular, the Fed kept interest rates low to help with financing the war effort. So that was the case when there was not much central bank independence. Then the Fed Treasury Accord of 1951 was an agreement to give the Fed more independence in setting interest rates, but it really took several more decades to have the kind of structure that we have now. And that trend towards more independence was a pretty worldwide one.
And so what is the value of independence? Why is this something that we should try to seek in a modern macroeconomy? Because even if 1951 is this starting point, I mean, there were some good times before then where monetary policy really was helping the will of the people and what fiscal policy was trying to do.
Yeah, the key value is price stability. Without an independent central bank, if you have monetary policy just controlled by politicians who have always this concern about being elected or reelected, they're going to tend to want easier monetary policy because their short-run goal is getting reelected. That comes at the cost of the longer run, which is higher inflation. So this is called an inflationary bias. It's just this tendency to want easier monetary policy if you let people with short-term interests control monetary policy. Putting it in the hands of technocrats gives like a longer-term perspective, so they are better able to prioritize price stability because they don't have that concern about their popularity in the short run.
I have to wonder if any central bank is truly independent. So the people that work there are still members of society that probably don't want to be totally hated by their fellow citizens. And they know if they do anything totally drastic, the public might find a way to remove them. And at the Fed, you do have congressional testimony twice a year by the chair. Is central bank independence more of a spectrum than a dichotomy?
It's certainly more of a spectrum than a dichotomy. Yes, a lot of measures of central bank independence, on a scale of 1 to 100, say, they might measure different dimensions of central bank independence. But yes, the idea that central bankers have reputational concerns is an important part of it. But it's just that most central bankers, like their reputation largely rides on, can they keep inflation down? At least the hope is they'll be popular if they keep inflation at target or if they keep prices stable. So they don't want to risk their reputation by letting there be a big inflation episode. So that's going to lead them to be more cautious about inflation than a politician would be. But you're right, they still care about their popularity, but we try to make it so that their popularity mostly depends on price stability.
I understand the connection between independence and kind of the longer term optimal inflation path, but how do you balance independence with public accountability? I mean, Fed governors it's very difficult to remove them. The regional Fed presidents are appointed by those different districts. So far in the Fed's history of, let's say, since Paul Volcker, the Fed, even if they have made mistakes, they have been, I think, pretty well-intentioned individuals. But if they decide to go rogue or really make decisions that the public doesn't like, how do we keep them accountable?
Yeah, that's a great question. So the Fed is accountable to Congress, and then Congress is accountable to the rest of us. In big part, it's the job of Congress to monitor what the Fed's doing, like those congressional testimonies you mentioned. They try to be transparent in a number of different ways with the speeches they give and the different reports they provide, the forecasts they provide. Congress has an incentive to monitor the Fed and to try to kind of keep them in line, because if we're unhappy with how the economy is running, we can vote out Congress, right? So even if we can't really have a say in who's at the Fed, have that indirect channel there where all of us can vote for members of Congress, and they have this interest in keeping the Fed doing monetary policy and whatever they see as best for their constituents. But it is a really hard balancing act.
You've written about the distinction between de facto and de jure independence. What's the difference here?
De jure central bank independence is the independence in the law. What do the official laws say about the institutional structure of the central bank? Different authors like Anna Garriga have made indexes of central bank independence based on looking at the law and saying, you get this many points if term lengths are long, and you get this many points for different kinds of protections against firing and things like that. So they come up with kind of a weighted average of all the different dimensions of official central bank independence that you might think about. De facto central bank independence is more about what actually happens in practice. So even if the law says that the central bank is very independent from politics, politicians could still play a pretty big role in influencing monetary policy through kind of indirect or subtle channels. That's a lot harder to measure. I've tried to do some studies of it using anecdotal evidence coming from reports about politicians pressuring central banks and trying to make data sets from those reports. But it's harder because it's not really written down in the books anywhere.
So the way that I understand that is that institutional norms can be more important than what's written on paper. So I believe the Bank of England was not legally independent until the late 90s, but the UK managed to have a pretty prosperous modern economy. Is that an example of how legal independence can be less important than the norms that are within the system?
I think both are important, but the norms and the culture are too. And if you have a culture that's very averse to inflation, and that's going to punish politicians for inflation more, then you're going to have these norms for price stability and for the politicians kind of keeping their hands out of monetary policy.
Are there any examples where there is de jure independence, but de facto not very much, so the opposite of what I just said about the Bank of England, where, yes, on paper, legally, this central bank is very independent, but they experience, for whatever reason, a ton of political pressure to do what the officials in office want them to do?
Yeah, there are plenty of examples of that. Often it's when the when the de jure independence has kind of been externally opposed. Say if the IMF has insisted that the country pass some central bank independence measures, but there's not that culture or that norms, and especially if there's a large fiscal problem like a big debt, there ends up being still a lot of pressure to monetize the debt or to cut the interest rates. So yeah, that's actually probably the more common example.
Now, talking about the Fed specifically, how does the Fed score on these metrics you talked about in a cross-country comparison to other central banks around the world in similar economies? How is the Fed in terms of de jure independence and de facto?
It does pretty well in terms of de jure independence. Then de facto, so there's not that many measures of it, but I think until recently it also did pretty well. There was pretty strong cultural norms against politicians openly pressuring the Fed. I haven't tried to measure it or anything lately, but the recent criticisms of the Fed by the president, I think, would be considered a sign of less de facto independence, although the Fed is really resisting those and really saying, no, we're going to do what we think the data tells us to do, and we're not going to be swayed by what the president tells us to do.
So on paper, I feel like the Fed has a pretty good foundation for the institutional guardrails that would prevent political meddling. So the regional district presidents are appointed by the districts, so that's decentralized. And then the governors have these 14-year terms. And so even if the chair is chosen as someone who is going to make decisions based on things that are favorable for the president's political performance, well, you still have 12 voting members of the Federal Open Market Committee. So on paper, the Fed seems very difficult to manipulate, but how do you think that will stand up this time around? Do you think that these external pressures are really new and we haven't seen the FOMC come across this type of external pressure before?
Well, I think that the Fed has always faced similar kinds of pressure, although maybe not quite as openly and blatantly as recently. That part of it does feel very different, that it's become a sort of public spectacle of the president versus the Fed and these kinds of threats being deliberately very public instead of kept undercover. Yeah, I think it's really important what you said about monetary policy is done by a committee here. It's not just the decision of the Fed chair. So, I don't know what's going to happen with the Fed chair, but the different members of the FOMC have long and overlapping term lengths. So the whole committee does not just turn over at once. And that's pretty important because no matter who the chair is, they're not going to single-handedly be able to make monetary policy. So that gives a lot of protection and keeps things on the side of basically sticking with the status quo. The issue is that the public perception of the Fed could really change. Congress could feel more compelled to also start interfering with the Fed because they know that their constituents aren't happy with the Fed because of the way this whole public spectacle has played out.
I think this goes back to one of my questions earlier about how members of the Fed still have a kind of reputational outcome that they are trying to maximize. And I think you make a really good point about public perception, which is that independent actors in politics, whether it's a judge or regulator in the executive branch, their credibility depends on the public perception that they are being fair and unbiased. And I imagine a scenario where, okay, let's say that 11 of the 12 members of the Federal Open Market Committee stay the same, but there is a wave of public criticism about how the Fed is no longer really speaking for the people. This renovation of their new buildings is really outrageous. That could sway different institutional guardrails, and maybe members of the Federal Open Market Committee would not be able to really be confident in doing what they think is the best for long-term price stability. Does that logic make sense?
It does. Historically, a lot of the members of the FOMC are academics, people who are probably planning to go back into academia or to a think tank or something after their stint at the Fed. So for an academic, you really care about your reputation with other academics, right? And they know that the other academics really are going to judge them on price stability. So that helps in keeping it, even if they're getting criticism for other things, they know that their professional reputation probably rides on how well they keep inflation near target, how well they seem to be following the best of the academic literature as far as what they should do with monetary policy. The Fed is taking different kinds of measures to take public opinion into account. For example, they have these Fed Listens events as part of their their framework review that they now are doing every 5 years. And so they will hear, I'm sure, things about the renovations and other sources of public dissatisfaction. And I think that's a good thing. Some of these have to do with price stability and some don't, right? So the members of the FOMC, when they're setting the interest rate, that's kind of a separate question from how much should they spend on their building renovation. If the kind of people who are appointed to the Fed eventually really changes, so it's not academic economists and academic lawyers, but becomes more politicians and party loyalists who are the main people on the committee, then that really could change what their end goals are.
I do hold these two ideas simultaneously. The first is that central bank independence is really important for long-term price stability, and then also that it is very difficult to erode the independence that the Fed has built up so far. But what we have seen throughout the first 6.5 months of this year is that the bond market has responded to criticism from the president, which I take to mean that investors are taking these threats very seriously. Do you think, in the grand scheme of things, those reactions are actually quite small? And if we saw a serious threat to the Fed's independence or credibility, the bond market would go totally crazy in a way that we've never seen before?
They have to react some. Anytime there's some sort of threat to the Fed's independence, even if it's a small chance, there's still a chance that you're going to get lower rates, more inflationary policy that should lead to some sort of bond market reaction. Whether it's been an overreaction, I'm not really sure.
I want to end with a question addressing something that you talked about earlier, which is the idea that the Fed's credibility has really built up over a long time, since 1951. It seems like it is a lot more difficult to gain credibility than to lose it. You could lose it quite quickly, but then getting it back is hard. So are there any examples of central banks that have lost their independence and then got it back? And how has that impacted those economies and interest rates during that kind of transition process?
You sort of see that in the case of the Great Inflation and Volcker disinflation, where the U.S. in the 1950s, they didn't have the kind of central bank independence as today, but they did have a quite modern style monetary policy where they did prioritize price stability. Inflation was pretty low and stable throughout the 1950s. So if you were to kind of look at it from, say, the end of the 1950s, you would say, yeah, they seem to have pretty good credibility. They're doing the right thing with interest rates, and monetary policy is quite good. They lost that in the 1960s when there started to be too much monetary expansion. Inflation started gradually rising, and as it rose and as they stopped doing enough to combat it, inflation expectations also started rising. Eventually that accelerates into the Great Inflation, where they really lost all credibility. And it was very hard to regain that. It took the huge, early 1980s recessions that went along with the Volcker disinflation before inflation finally came down and the Fed reestablished its credibility. And there was a lot more respect for central bank independence after that, because throughout the 1970s, there really wasn't a view that monetary policy was the right tool to bring inflation down. Some of the Fed officials themselves thought that monetary policy couldn't do it, that we needed price controls, wage controls, different types of fiscal policy in order to bring inflation down. But after the Volcker disinflation, there was a much more wide perception that monetary policy was the tool to use and that an independent central bank was the right institutional setup to be able to do that.
Carola Binder, thanks for coming on the podcast.
Thanks for having me.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.